Well, greetings, everybody. The first quarter of the year is over. It's been a tumultuous quarter, and Tarek's going to do a recap on that, and then I'm going to take a quick look at what's coming up next. Tarek, go ahead, take it away.
Thank you very much. Well, I'm going to start with our momentum strategy. The reason I'm going to start there is because we're quite happy with how the momentum strategy has performed in the last quarter. So we're looking at over 13% returns for the first quarter of 2022 on the momentum strategy. And that's compared to the Toronto Stock Exchange, which did just a little over 3%. So we're seeing substantial outperformance right now. And that's for a couple of reasons. Of course, we've been paying attention to the news. The big thing is the war in Ukraine, and that has greatly affected commodity prices, oil and gas, other natural resources, mining, precious metals, things like that. And the way the momentum screens were planned out and were designed, we actually ended up owning a lot of those stocks and saw strong performance. It benefited the Canadian economy in general, but momentum really took advantage of that, and we're really happy about it. Moving on to the enhanced index strategies.
Derek, can I just jump in a second? I want to tell one story on the momentum, because I saw a headline halfway through the quarter, and it said that Shopify was down 62% from its high.
Right.
And I was like, whoa, hang on a second. We have owned Shopify for most of the last 2 years. I think there might have been 1 or 2 quarters where we didn't, but it was the rock star of COVID season. Everybody was shopping from home, and it had been, just on a straight line going up. And I thought, oh no, what if it's in our portfolios?
Right.
Dang. So quick as a whistle, I open up Index, which I invite you to do anytime you like, when you want to see the value of your portfolio. I opened up Index and took a quick look at Elaine's. Now, Elaine holds our momentum, and I hold the boring stuff that Derek's going to talk about next. So I look at Elaine's account real quick to see if Shopify is in there, and it's gone.
It is not, yeah.
So I checked with Tarek on when we sold it, what we sold it for, and then I looked at the chart. I checked it again today just to see where it's at. So we sold it at the end of the third quarter. So that would have, the cat's here with us. I'll get rid of it. We sold it at the end of the third quarter. We sold it at about $1,719 per share. I want to say it was not the high. It went on up to just over 2,100. We could beat ourselves up. Unless we look at it today. And today it's about 700. I think it was 747.
Ooh,
same number, just
drop.
Flop off a 1. Just take off a 1. Wow. So I was really, really encouraged to see that this system works. I want to say the stocks that do this kind of a takeoff, they're typically bubble stocks. They're not good fundamental stocks typically. And so when you buy into them, you're buying something that you go, okay, you've got to get out of there at the right time. Rebalancing quarterly, really important. Number 2, when a stock does this, it doesn't just turn around and go straight down. It does this, and then it wavers, and it starts to weaken its pattern. And that's what our screens identify as, okay, now it's a change pattern, kick it out. And on September 28th or 30th, we kicked it out of the portfolio, across the whole of our portfolios. Okay, Tarek, back to you about enhanced index.
Absolutely, I love it. And that just demonstrates that the screens work, the system works. So if we look at our enhanced index portfolios, the boring stuff, as you said, on the aggressive growth side, we saw solid growth, if not momentum level growth, but we saw it was up 2.5% to 2.8% for the quarter. And this is the 80% equities, 20% fixed income portfolio. On the other side, on the conservative side of the enhanced index, we did see a slight loss of between 1.6 and 1.8%. That's just because of the heavy bond component, and interest rates are rising right now, which is really weighing on bond returns. And so a high bond portfolio will have a harder time right now.
Right. And these are, the enhanced index are global portfolios. We're going to do another video that we'll send to you as well, that does a little bit of a description on our 2 strategies, the momentum and then the enhanced index. And you'll begin to understand how that works together. But these are global portfolios that have a component of fixed income. I'm going to use that to look ahead to the next quarter. at the beginning of this last quarter, we were looking ahead and we said, it appears to be a natural resource market. We could not have made a better prediction at that point. Typically, when a market does this type of a trend, it's not over in 3 months. They're often 2-year trends. They go usually well beyond what everybody expects. And so it continues to look like a natural resource market. Our screens at the end of the first quarter on March 31 kicked out the same thing, stay in the natural resources. In fact, six of the names that, I'm sorry, I'm back on momentum because 6 of the names are in there. It's a natural resource market. Number 2, it's an inflationary market. That means it's very much a bond hostile market. You do not want to be overweight bonds in this kind of a market. Now, in our portfolios on the enhanced index, you've got conservative over to aggressive growth. And aggressive growth, we identify that way in the classical terms because it's only got 20% bonds, 80% equities. This one down here has 65% bonds, 35% equities. And in classical terms, that's determined as safer. Not in this market.
Right.
If you want to take a look at your mix, and if you want us to rebalance you and move you into something that's, I think, less risky, but in classical terms will be defined as more risky, you will take down your bond portfolio and you'll own more equities. We would like to talk to you about that. We don't want to do something that's not suited to your needs.
Right.
So we're not trying to encourage you to do that, but we want you to understand in this market, and probably for the next 2 years, interest rates are going to be rising, could be longer than 2 years. And you need to know that that's not good for performance. You're going to feel it at our firm or any other firm. It doesn't matter which, that's what happens to bonds. So I wanted to just be sure to talk about that mix of bonds. And if you need to talk about it or think about it, just give us a call and we'll work on it with you. I think I'm done. Tarek, anything else?
Absolutely. Thanks for saying that, Mark. It's a really good point to take to heart. The only thing I would mention is, if you do have investments outside of Tower, other firms at a bank or whatever have you, if you haven't had a look at them for a little while, we would love to have a look and see if there's something we could do, or if we can give you an idea of, maybe the ways that it can be managed better. I know we had a couple clients in this last quarter take a look at some of their outside statements and realize that, I haven't been watching this closely and it hasn't been doing very well, considering how things have been going the last couple of years. And so they decided to move it to Tower. And I'm just saying, hey, we're here. We would love to take a look at your investments and make sure that you're getting the best service and the best products that make sense for you, where you're at. So
your cell phone will be on the email that goes with the statements. Good.
Absolutely. Awesome.
Thanks, everybody. Have a great quarter.
Talk to you soon.